Good day, everyone. Thank you so much for joining us today for the Tax and Legal Update for 2025. My name is Meagan Fraser, and I will be covering the tax aspects of today's presentation. To go through the agenda for the day, we will be doing a short budget highlight session to cover some of those key policy proposals that came through in the budget for 2025. We then will move on to a two-part update with some insights and learnings. We then go into a short break for about 10 minutes. And when we come back, we'll be shifting gears slightly to go into two topics for non-resident clients. So the first is we'll be talking about advising non-resident clients. And then we'll be also covering some of those changes to the Income Tax Act that came in 2024 regarding distributions to non-resident beneficiaries of local trusts. So without further ado, let's get on to our budget highlights. I will just be touching on some of the key tax proposals that were announced by the Minister in that speech on the 12th of March 2025. The Minister of Finance was once again tasked with balancing the government expenditure bill with the country's revenue collections this year. And in order to do so, his options are either to decrease government expenditure or to raise additional revenue. So let's just remember that he really only has three levers to pull when it comes to raising additional revenue for the government, being personal income taxes, corporate income taxes, and value-added tax, or VAT. The big lever that he has chosen to pull this time around is that of VAT. So the Minister proposed a 0.5 percentage point increase in each of the next 2 fiscal years, bringing the VAT rate to 16% by April 2026. So we should also remember that the second increase is currently not guaranteed, as the Minister did confirm that it would be reconsidered if government spending reduced and other tax reviews produced sufficient additional revenue. In order to alleviate the additional financial pressure that this proposal will place on low-income households, we also received confirmation that the bucket of zero-rated goods will be expanded to include some additional basic foods, and an above-inflation increase on social grants was also announced. Personal income tax brackets and rebates were not adjusted this year, unlike in that abandoned budget of 19th of February, in which we saw both inflationary and below inflationary adjustments to the low to middle income tax brackets. This second year of bracket creep will hit middle income earners the hardest, and the standard of living costs across all households are also set to increase as a result of that 0.5% VAT increase, which will be effective from the 1st of May 2025. So from an Allan product perspective, this VAT increase will also affect the fees charged on your client's investments, effectively increasing the cost of saving. As you will be aware by now, there has been significant noise in the industry regarding the tax treatment of capital gains by collective investment schemes as well. To provide some background, in 2018, amendments were proposed in the Taxation Laws Amendment Bill to clarify the income tax treatment of trading profits earned by collective investment schemes, or CISs. These amendments arose due to the fact that National Treasury had come to the realization that some CISs were generating profits by frequently trading shares, and that depending on the circumstances, these amounts could be seen as revenue in nature and therefore would be taxable. So after the public consultation period for that 2018 bill, government decided to withdraw those proposed amendments to allow them more time to work with the industry towards a solution that would not negatively impact stakeholders. Subsequently, on the 13th of November 2024, National Treasury published a discussion document which set out two main policy proposals regarding the taxation of CISs. These proposals elicited strong reactions from the stakeholders in the financial services industry, and Allan was amongst those who submitted feedback to National Treasury via the Association for Savings and Investment South Africa, or ASISA, to warn that these proposals could have a detrimental effect on the savings culture in South Africa. The first proposal, which was contained in the discussion document, was to make CISs fully tax transparent. So from a fund manager perspective, this would require daily reconciliations and valuations of disposals and purchases made within the CIS, and the realized gains and/or losses on this trading activity would then be allocated to investors at the point in time the trading has occurred in the fund itself. So whilst this option still results in the taxation of gains and revenue being in the hands of investors only, with the CIS merely being a conduit, this method would mean that the taxation on gains in the hands of unit holders will occur regardless of whether they have redeemed any units in the fund, meaning that the corresponding liquidity that would be required to cover the tax on these amounts may not be immediately available to investors. The second proposal put forward by National Treasury was to implement a safe harbour rule by setting a ratio between the trading turnover and the portfolio size, such as say 30% for example, for allowable capital trading. So this would mean that below this threshold, all proceeds earned within the CIS would be deemed to be capital in nature, but above this threshold, the relevant facts and circumstances would then need to be assessed in order to determine whether proceeds would be deemed capital or revenue in nature. No further proposals were received from National Treasury in the budget speech delivered by the Minister on the 12th of March, but National Treasury did confirm that they do not intend to tax all profits earned by a CIS as revenue in nature, and that they would continue to consult stakeholders in an effort to provide clarity on the issue at hand. An additional noteworthy piece of legislation that came through in the last legislative cycle, which will impact your clients' retirement savings, are the amendments made to the rules for transfers of retirement annuity funds for members who have reached retirement age. So if you remember, last year we noted that effective 1 March 2024, any occupational fund members who were subject to an involuntary transfer of their pension or provident fund to another pension or provident fund, but who had reached the retirement age as stipulated in the rules of their fund, would now be able to do so in a tax-free manner. So in the 2024 Taxation Laws Amendment Act, which was promulgated on the 24th of December 2024, we saw that National Treasury aligned the treatment of post-retirement age transfers for members of retirement annuity funds to that of the occupational funds. It is important to note that these members may transfer their benefit to another fund in a tax-free manner, regardless of whether or not the transfer is of a voluntary or an involuntary nature.